Yeah, if you, it's your show.
Hello, everyone. Thanks for joining us. We are here today with Josh Gonzalez, who is with Modern Wealth, and he is my go-to, my guru. Worked with him for several years with New York Life. He's phenomenal, the only one that I trust, and um, and he's here today to talk to us about seven mistakes that DIY investors make. And we are going to let him go ahead and take it away.
Thanks, Cheryl. I lost you somewhere there. So, can I get a one in the chat for everyone who can hear me? And then if you can't hear me, can you put a two in the chat, please? Everybody on here? Okay. I'm getting all ones. All right, that's encouraging. Okay, great. All right, thanks everybody. Yeah, Josh Gonzalez here. Known Cheryl for probably the better part of a decade, if not longer. I've been in the investment advice and financial planning business. I'm in my 17th year now, and Cheryl's a dear friend, great business partner, and I always covet the opportunity to chat with her and her tribe here. What I want to share with you today are the top seven investment mistakes that DIY, do-it-yourself investors make. They're not presented in any order of importance. These are things that I've seen in my nearly 20 years of experience of affecting portfolio reviews, portfolio analysis, and financial plans for hundreds upon hundreds of households. So this is you're going to be able to take notes. Cheryl's going to record this for her subscribers, and hopefully you're not making any of these mistakes, but to the degree that you are, you're able to correct them. So just to give you an overview of what they are, and I'll go into each one of them. They're going to populate on your screen right now. Right. In no particular order, the seven most prevalent mistakes that I see do-it-yourself investors make are number one, an overconcentration in low yield assets. Different way of saying this is not enough high appreciation assets or investments. Two is tax inefficiency. This is where you hold the wrong kind of assets in the wrong kind of account. Because different accounts have different taxability rules. And that will sometimes dictate which investments are really optimal to hold in them. Third is over diversification. And I put that first because everybody knows four, which is under diversification. So in the same way that we know that diversification is almost always preferable to an over concentration in one sector or in one stock, you can have too much of a good thing. So three and four are the two sides of the same improper diversification coin. Five is following fads, and I put the FOMO acronym, fear of missing out acronym, in the parentheses. Six is panicking in downturn. Uh, I see this one the most as an investment advisor and a financial planner. Number six, panicking in downturn, is far and away the most committed mistake in do-it-yourself investing. And seven is investing for current yield rather than total return. That's taking a short-term approach to your investment allocation. So we'll start with number one, which is an over concentration in low yield assets. And what you have on the screen in front of you are the aggregate returns from 1929 to 2016. So this is a very representative period, nearly 100 years of stock market performance. And this graphic shows you the base inflation rate, treasury bills, government bonds, large stocks, and small stocks. And it gives you the average annual rate of return. It's a calculation called the geometric mean return of these varying returns. Now, what you'll notice is there have been times where the world came to an end. We had that in 1929 and in the 1930s with the stock market sell-off and the Great Depression. We had a mini economic downturn after World War II. We had an oil embargo in the 70s, and we saw the stock market go down. We had the dot-com bubble in the late 90s and 2000, and the 2001 terror attacks on September 11, 2001. And those are the downturns that you see here. But if we were to draw a line in general of stock market returns as well as bond and treasury returns, in general, the stock market in the last 100 or so years has only gone in one direction. And really, what these downturns represent are buying opportunities. So what we see a lot of in investment advice and financial planning and retirement accounts is that people are rightfully weary of these downturns, right? We had a downturn in 2022 just recently where the market as measured by the S&P 500 index pulled back 20%, which means if you had $1 million on January 1 of 2022, you had 800,000 on December 31, 2022. So what happens is this prompts people to concentrate or over concentrate on cash, treasuries, and bonds. And in the long term, when you take a long-term view, that is a big mistake. This is the difference between having $100, $7,000, and maybe as much as $30,000 from a $1 investment a lifetime ago. So over concentration in low yield assets. This is forsaking long-term profits for the sake of avoiding short-term paper losses. Always a mistake. Very, very big mistake. Next, tax inefficiency. As I shared with Tom before we started recording, different accounts have different tax rules. Pre-tax or traditional IRAs are taxed differently than post-tax or Roth IRAs. That also applies to 401k, 403b, TSP, which also have pre and post-tax features in most plans. They're taxed differently than buying individual stocks, buying individual bonds, buying ETFs and mutual funds. Those have their own tax ramifications, both in the current year for investments that produce income by way of dividends or interest on bonds, or when we sell out of a position for a gain or a loss. So the kind of account that you own is going to dictate or should dictate in a large way where you hold or what kind of investments you hold and where you hold them. So this is something of a more complex topic, and this spectrum I'm not going to go into today. But for the sake of simplicity, to make something really complex a little bit more simple, it's a good idea to do a tax efficiency checkup on the actual holdings within all your accounts. Third is, and fourth, are over diversification and under diversification. So under diversification is well understood. This is when all of your investments are in one or a small handful of stocks. I can give you an example. We have one client who just made a killing with Apple over the last 20 years. And built a very strong 7-figure balance sheet. But at one point, 70% of her net worth was all in Apple. So now, to date, that has not been a mistake. But going forward, to what degree should 70% of anybody's investable assets be in one holding? So that's under diversification. The other side is over diversification, where you have every egg in your basket. And what happens there is something called dilution. And dilution means every time you have a gain somewhere in your portfolio, you have a loss somewhere else, and you get a middling or muddled return. So over diversification could be just as bad for your long-term returns as under diversification. The next big mistake is fear of missing out and following fads. Does anybody know who or what this is, this graphic? This is Bored Ape Yacht Club number 3001. And at one time, back in May of 2022, Bored Ape Yacht Club number 3001 was worth over 120 wrapped Ethereum tokens. As of this morning, it's worth 11 and a half. So that's about slightly under 3 years. There was a time when this was the rage, and if you didn't hold this NFT, you might have felt like you were going to miss the boat, and everybody was going to get rich except you. And a lot of that describes a lot of the investors who bought this NFT back in April, May of 2022. And now we see where they are now. And you can see where this market has gone in the last 3 years. So when you see that everybody is gravitating towards something, that should trigger your spider sense. Usually in investing, it's better to be going against the stream and against the herd than with it. And Bored Ape Yacht Club number 3001 is a great cautionary tale, an example of that. The sixth uh, mistake that I want to talk with you about today and share is panicking in a downturn. Like I said, this is the number one. So going into 2020, nobody could have predicted that coronavirus, COVID-19 would enter the world stage and would cause global shutdowns of economies and communities and society as a whole. This graphic is the timeline of two investors, one who holds $100 in stocks and one who holds $100 in bonds, from January 1, 2020 to December 31, 2020. And what you'll see is no surprise in the first couple of months, the stock investor outpaced the bond investor. But then schools started shutting down, businesses started shutting down, global travel, global tourism, global trade started shutting down. And that $100 investment went down 30%. While the bond investor still had 99 cents out of every dollar he had at the beginning of the year. So at this point, the bond investor is feeling really smart, really safe, and the stock investor is questioning his life and everything about it. But as Chicken Little learned, the sky never actually falls. And people, humanity, very resilient. We figure out a way forward. So much so that by the fall, pardon me, by the summer, we'd made all our money back. By the fall, we were back ahead of bond investors, and we finished up 18%, while bond investors only finished up 8%. So if 2020 doesn't convince you that stock ownership is superior to bond ownership, I don't think anything will. In the short term, the stock market is driven by headlines and is highly emotional. But in the long term, as we saw in the first slide, there's a very strong track record of superfluous returns. And their final mistake is going to be investing for current yield versus total return. So it just so happens that every once in a while, for a few months at a time, treasury or bond yields look more attractive than dividend yields or stock returns. And this graphic, which is a little bit complicated for the uninitiated, shows that. Well, you see periods here where the orange line is higher than the blue line. That's when the short-term yield on 5-year treasuries is higher than the S&P return for the year. So the challenge is it does happen every once in a while, here, 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 and here. And what this does is it gives the pessimistic or cynical investor temporary ammunition to justify what is probably a long-term mistake. Most of the time, as we see here, this is another very representative period of time. This is 1932 to 2020. Again, this is a close to 90-year sample size, which is statistically valid. Rolling 7-year returns for stocks are almost always higher than the rolling 7-year return for bonds.
Did he froze on your side?
Yep.
Uh, all right.
Cheryl, where did we get lost?
The 7-year
Okay,
average, the
that's fine. That's fine. So uh, that was the last slide. Uh, to recapitulate the 7 most common investing mistakes: over concentration in low yield assets, tax inefficiency, over diversification, under diversification, following fads, panicking in a downturn, and investing for current yield rather than total return. If you'd like, I'm happy to field questions, or we can adjourn. And what I'm going to do is I'm going to put my information in the chat again, since we did lose the stream for a minute. Cheryl?
all right. So this was a lot of information. There was terminology. I was getting a few messages that there was terminology that was that went a little over the head.
Yeah, if
However,
you want me to simplify or break down some of that, I'm happy to.
if anyone has questions, feel free to jump in and ask. I have firsthand knowledge that Josh is great at teaching these pieces. You just need to tell him what it is that you need to know. Crystal says, where can I go to get information on investing in stocks for beginners?
I would point anybody who wants to start understanding this to the actual exams that aspiring investment advisors and financial planners have to take themselves. So there's something called the Security Industry Entrance Exam, the SIE. You The study materials are often free or they're very low cost. This is a great starting place for even lay people who are never going to be in this industry professionally. It's a great place to uh, start where somebody like myself started. So the SIE Security Industry Entrance Exam uh, is a great place to begin familiarizing yourself with these topics.
Awesome. Elizabeth says, if you had only one investment vehicle to choose from, which would you choose?
Yeah,
Examples,
Roth
Roth
IRA,
IRA.
401. Okay. Yeah, so I'm really glad Elizabeth posed this question, because a lot of times people don't understand that IRA, 401k, TSP, 403b, pension, tax sheltered annuity, these are not investments. These are carve outs in the tax code that dictate how your underlying investments are taxed, how and when they're taxed. So your 401k is not an investment. Your IRA, your traditional IRA is not an investment. Your Roth IRA is not an investment. None of these are investments. They are provisions in the tax code. A stock is an investment, a bond is an investment, a collection of stocks or bonds in the form of an exchange traded fund or ETF is an investment, a collection of stocks and or bonds in a mutual fund is an investment, a real estate investment trust is an investment, a private placement is an investment. Those are investments. So What you're going to use is first, how and when do you want the money and for what purpose? That's going to dictate if you use a tax qualified account or something outside of a tax qualified account. Tax qualified account being IRA, 401k, that genre. And then the type of return that you're aiming to get and your timeline and your ability to weather a downturn or a loss or an adverse outcome is then going to dictate your underlying investment. So that's how investment selection and analysis is done. There, there is, you have to almost take an agnostic or surgical view of these things rather than a moral view. I would think of it like this. People in terms of good or bad. There are no good people or bad people. There are only charming people and tedious people. And it's cheeky and it's funny and he's right, but you have to take that sort of ironic view into other facets of life. There are no good investments or bad, well, there's certainly bad investments. Uh, but there are no like must own, gotta have it, great investments. Everyone should own this. Uh, you have a stated goal in life. Maybe that's to get out of, maybe that's to get out of working for a living when you're 55. Maybe it's to retire at 70. Maybe it's to get your youngest kid through college and just get over that hump, and then you don't care what happens after that. Uh, there's all sorts of different scenarios and life goals. And the kind of investments that you hold and the type of accounts where you hold them should be a downstream or subordinate decision to your overarching life goals. And as a financial planner, that's actually the value add that I bring. People think it is the investment expertise and managing investments and security selection and all of these sexy things that people think is way beyond them. That's really not it. Where I come in is really to perhaps help you think about your life in terms that you haven't thought about it before, in terms of your money, your relationship to money, and what you really want to do and what outcome you want. And for a lot of people, that experience that I just described is very cathartic. They haven't really done that before. But if you can do that and you can crystallize it in your own mind, then the accounts and the investments, all that, it falls into line because it's just a tool. Like I said, there's no good investment, must own investment. These are tools, right? You shouldn't have an emotional relationship to your retirement account. You should not. You shouldn't feel strongly emotionally invested to any one company or any portfolio or any strategy because it doesn't love you back. It doesn't care about you. It doesn't care if it returns or not and allows you to retire. So it is a utilitarian decision and it has to be in service of you and your goals. So I hope I didn't get too esoteric or woo-woo or, philosophical, but that's how you have to really think about your investments and these kind of accounts.
Mary had her hand up. Mary, are you able to?
I think my question might have been answered,
Okay.
or I kind of lost it somewhere in there.
All right, Mary. Well, if it comes back to you and I haven't answered it, please raise your hand
Quick
and pose it
question,
again.
actually, I did think of one. Do people usually like do a consultation with you and then they like understand it, or do you like manage people's portfolios for them?
Yeah, the answer is both. The answer is both. Some clients want to or need to cede control of their investments. These are what I call outsourcing clients. There are clients who, for whatever reason, whether it's temperamental, personality, or they're victims of their own success. They're so busy doing well and winning in other facets of life that they just can't get to it. And it's cheaper and more effective to pay me and my company and my team to do it. So those are outsourcers. And some people should want to need to be outsourcers, and we help outsourcers. And that's an investment advice, investment management kind of engagement. Some actually a lot of our clients, this has been growing over the last several years, and this is the trend in the industry. Most people are validators. They have the mental or emotional discipline to hold their positions and not panic in a downturn and not make any self-inflicted mistakes. But they lack some of the perspective and some of the expertise to integrate that with all the other facets of their financial life: insurance, estate planning, trust and wills, benefits at work. And what they really need is somebody who is, again, removed, can be dispassionate and objective, and help them integrate those investments with every other facet of their financial life. That's a consulting engagement that's usually done on a flat fee or a quarterly or annual um, fee with a lower ongoing subscription after the first year. And that is something that we transitioned to about 5 or 6 years ago. It's growing in popularity. It makes up a larger share of our clientele base over the years, because what it does is it allows us to meet people where they're at. So, like I said, some people need to really hand over the reins and hand over everything and let go and let Josh. And we we help those people. But some people, like I said, they need someone else who brings a different perspective, who has this multidisciplinary professional expertise that can integrate it all together and help them uncover a few ideas and strategies that they otherwise wouldn't have. Like I said, those are usually flat fee consultation arrangements. Thanks for asking that question, Mary.
Thank you.
Yeah, you're welcome.
So, how much do I need to get started? Like, if I wanted to just, like, I don't have any investments, where do I start? I mean, other than, like, I don't know, what's that one called? The things that the apps.
Yeah. Well, the first place there's really two things to do. First, for anybody who wants to engage in any kind of financial planning, any kind of long-term investment or retirement planning, the first thing you have to do is take inventory, right? So everything you have, retirement accounts, non-retirement savings and investments, your bank accounts, your real property, your personal property, take inventory. Take inventory of that. A lot of people run away from that. And part of the reason they run away from that is because there's another side of that balance sheet, which is your liabilities, your debts. But you need an inventory of that as well. So step one is take inventory of your financial or material life. And again, for a lot of people, the hang up or the hesitation is psychological and it's emotional. But if you can run into that brick wall, I promise you can run through it. And you're going to feel so much stronger and you're going to feel so much more empowered by tackling it head on and just putting it right there in black and white on paper and just saying, this is where I'm at. This is what I've done, but I can improve upon this. Right. Or perhaps you see it and you say, you know what? It's not as bad as I thought it was going to be. I can work with this. So that's step one for everybody. Take an inventory of where you are. Assets, liabilities, we call it a balance sheet. You take all your assets, you subtract your liabilities, that's your net worth. And that's a good starting place for everybody. The next place is your monthly cash flow statement. Everything that comes in, everything that goes out. Now, sometimes things come out once a year or twice a year. So if you live in Virginia like I do, you get smacked across the head with personal property tax for your car twice a year. Our property taxes for our houses gets our mortgage company fronts the money and then we pay them back over the course of the year at interest. So you can with expenses like that, you can simply or give you another example. Most people are auto insurance is a 6-month bill. and they bill us monthly. So whatever you have to do, if it's a monthly expense or a quarterly expense, if it's a monthly expense, divide it by 12. Put it in that sheet. If it's a quarterly expense, divide it by 3. Put it in. Really just try to get a good idea of where your money's going, right? Get a really good idea of where your money's going, because that's going to dictate your budgetary surplus. And I'll tell you what, for a lot of people, I would say the overwhelming majority of people, the only way you're going to be able to save and invest long term and successfully is if you build it in like a bill. Build it in like a bill. That's why your retirement plan at work works, because it's the same reason why the IRS makes your employer withhold the taxes. Because if they give you that gross paycheck and they don't withhold, they're not getting that money. We're all defaulting on our taxes this year. This whole house of cards comes crumbling down. They know they got to get it from you before you get it. The federal government knows that. The IRS knows that. That's why they have your employer withhold the taxes. That's how people are able to build up balances in their 401k, or whatever it is at work, for TSP 403b 457, et cetera, et cetera, et cetera, et cetera, et cetera, profit sharing, all those, because they do it automatically. They do it before they ever see the money. And to the greatest extent possible, if you're not able to do that through your employment, you want to duplicate that in your own life. So, yeah, Cheryl's saying that's why us self-employed people pay quarterly. So, yeah, those are two great starting places. And then I'll give you a third one, which is as far as investment and retirement accounts. Get statements for all those and look up the ticker symbols. Look at what your money's actually invested in. If you're in your 40s or early 50s and you want to retire in your 60s, there shouldn't be a lot of cash in your portfolio. I really don't want to give specific investment advice. I'm not giving specific investment advice, but I see it all the time. People say, "Oh, I got wiped out in 2007, 2008, 2009." Well, you were 15, almost 20 years younger back then. Were you even close to retirement? And how did you get wiped out? I mean, portfolios don't go to zero. The average mutual fund portfolio holds 2 to 400 discrete stock positions. We didn't have 100 or 150 or 200 or 400 companies go to zero and go out of business in 2007, 2008, 2009. The number of companies that went out of business we can count on one hand. Bear Stearns, Lehman Brothers, AIG should have went out of business. The government saved it, right? We had a lot of consolidation. You remember Wachovia bought Washington Mutual, right? And then years later, Wells Fargo ended up buying them. So, yeah. Elizabeth posed a question. Crystal, well, let me back up to Crystal. What is the next step once you've taken an inventory of your assets, ready to begin making investments? Crystal, the one word answer is yes. The longer answer is you're going to decide if you're going to do it yourself, if you're going to consult with somebody. But yeah, like I said, investment selection, investment planning is a subset of your goals. So you're going to crystallize your goals. You got to figure out your balance sheet and what you're working with on a monthly basis. And then, yes, you can start working toward actually investing and selecting the right investments. Elizabeth, do you think with all the political turmoil happening, it will be a down year for stocks? A lot of people will start pulling their money out. Yeah, I'm not in the prognostication business. Um, we have already seen what looked like adverse circumstances and impending doom turn around. So, for example, we went into the weekend under the belief that there were going to be tariffs on Canada and Mexico, and then there were going to be reciprocal tariffs, and those have been paused 30 days to allow, or the tariffs between the United States of America and Mexico have been paused for at least 30 days to give Mexican and American government officials time to perhaps hash out a trade deal. right? So if you called me on Friday afternoon or over the weekend and said, I'm going to move everything to cash because we're going to have reciprocal tariffs with Mexico and Canada, and it's going to tank the stock market by Monday morning at 9 o'clock, that was already OBE, overtaken by events, which again points me back to one of the canonical investing mistakes, which is allowing headlines and short-term trends to affect your long-term plans. Can never do that. Can never, ever, ever do that. What if you sold out in March, April of 2020, the bottom of COVID, right? You got to flip your thinking. I'll give everybody one more piece of um, one more lens to think about these things before we adjourn. And it's going to be a silly, ridiculous metaphor, but you'll get it. Let's just say you loved canned tuna fish. You love, love, love canned tuna fish. You put it on your toast in the morning, you put it on crackers in the afternoon as a snack, and it's your favorite source of protein, canned tuna fish. I hate it. All right, so canned tuna fish, you go to Heather, I see that face. You and I are on the same team. So you go to the supermarket, canned tuna fish, dollar a can, dollar a can, dollar a can. And one day you go there, it's on sale, 95 cents a can. So what do? You grab an extra can. You go back the next week, down to 90 cents a can. So now you grab 2 or 3 extra cans. Then you go back the next week, it's down to 80 cents a can. And remember, this stuff lasts almost forever. So what do? You grab a second shopping cart and you put all the tuna fish in the other cart, right? Because we understand that with goods, a low price is better. With any consumer good, we want, as consumers, we want the lowest price possible, assuming, right, assuming quality. Assuming quality, we want the lowest price possible. Okay. While we understand it with consumer goods, we don't understand, a lot of people don't understand it with stocks, right? The share price of a publicly traded company on an exchange is simply the market's opinion of what it's worth right now. And it's often driven by headlines and short-term thinking and short-term trends. And sometimes, for whatever reason, the market doesn't think the company will be as worth as much now or in the future as it was yesterday or the day before. And that's when the share price starts going down. But if you believe in that company or you believe in a portfolio that holds that company, when the market sells off, like the market sold off in March, April of 2020, is those stocks went on sale. Think about April of 2020, Carnival Cruises, Southwest, JetBlue, all those stocks cratered. Well, that was your opportunity to buy them because those stocks are up 50, 100, 200% since then. Right? So that's that's a lens that you need to think about, especially for those of you under 60. For those of you under 60, that's really important.
I have a question in regards, and I think it might fit in with what Elizabeth is asking in the chat. So I was going to ask about stash, that for somebody that's brand new, just kind of gives us an idea of things to
Cheryl, you
follow.
froze for me. Am I frozen for you?
Yeah, you were. Are we back now?
No, I think she just froze.
Okay. Ashes.
Oh, there, she's back.
I was asking if stash was a vehicle to kind of learn a little bit about the stock market, because you can put a small amount of money in and be able to follow some of the stocks with that.
Yeah, I'm not familiar with that platform. I've just looked it up and Googled it real quick. Like I said, I think for most people, especially within the sound of my voice right now, it's not a function of sticking your toe in and getting warm and then building yourself up to jump in. I don't think most people need to be DIY investors in the sense that they're going to be looking at their app every day or following tickers or following stock prices. Actually, the average person probably shouldn't do that. What you need is a principled, systematic plan. And again, that probably doesn't involve Robinhood or Stash or any of those things, right? Because most people will get rich slowly. And by get rich, I mean get out of working for a living, right? It's a multi-decade process where you're saving somewhere between 5 and 15% of your earned income over the course of 30, 40 years or so, 50. That in conjunction with Social Security is how you're going to get out of working for a living. That might not be the most inspiring plan, but it works. And it probably describes 80% of all Americans, if not more. And there's nothing wrong with that, right? You can't let perfection be the enemy of good enough, right? And sometimes we have to work within the realm of the possible. So, Cheryl, unless you got anything else, I think, we've been chat. We started at 10 after the hour, so we've been going for 40 minutes. I think that's just about the extent of my attention span.
So thank you very much, Josh, for coming today. And well, let's see. Eliana says, I have a 401k from my old employer, didn't roll over to my current employer 401k, but I noticed that the fees from my 401k from my old employer is a little bit less than my current employer. Should I leave it as is?
Categorically, I would say that, barring an aberration, the fees in 401k plan B versus the fees in 401k plan C is not going to drive the outcome to the way that the underlying investments are. So again, that's sort of a downstream consideration, right? Because most fees are, again, percentages of a percentage point. So I would say this, it'd be better to hold a high growth portfolio in a high fee account than a low growth portfolio in a low growth account. You'll end up with more money, right? So fees can be a red herring. I'm not gonna sit here and say fees are irrelevant. That's not true. But fees as a preoccupation can be a red herring and can be a sort of a dead end street to nowhere. Again, I want to know how much is in your 401k relative to how old you are. How much are you putting in your current 401k? Assuming 6, 7, 8% rate of return, how much are you on track for at age 65 or 70? Because if the answer is not enough, doesn't matter if the fees drop to zero. You still have a problem. So
All right. Well, thank you very much, everyone that is here and listening to the replay. Remember, Josh will be back on Friday for
yeah, let me plug. Yeah. So I'll be back Friday, February 7, same bat time, same bat channel, 12 noon Eastern Standard Time with Cheryl here on Simplified Accounting with Cheryl, to go over the 7 mistakes that people make with respect to insurance. So we talked about investments and these kind of accounts today. People make a lot of mistakes with insurance. So we're going to go ahead and go over some of those. And I would say between these two talks, it's going to take time. But the one with insurance, you can clean up a lot of those mistakes inside of 10 to 30 days. So that's a really good one that I look forward to sharing with you. There's going to be a lot of actionable, valuable information in there.
Fantastic. Well, thanks again, Josh, for being here. I look forward to being able to do more of these with you. And
Yeah, thanks for having me.
we'll see you on Friday.
All right. Bye, everybody.